This program is brought to you by the Kentucky Small Business Development Center in Louisville. We provide the professional expertise, tools, and resources to help you succeed. To connect with a business coach, call 502-625-0123 or email sbdcinfo@uky.edu.
Good afternoon, everyone, and welcome to another Toolkit Tuesday. I'm Janet Flaw with the Kentucky Small Business Development Center in Louisville. So let's go ahead and get started. I'm going to welcome today's guest, Raphael Collazo. He's joining us today. Raphael, are you there?
Yes, I am. Let me put my camera on. How's it going?
Excellent, excellent. So commercial leasing is something that we work with our clients on the daily. It's always a great concern that they make the best decisions for their business. And so we wanted to have an expert in the field come and talk to us about that. So Raphael is with the Grisanti Group. He's a commercial real estate person specializing in retail and multifamily leasing. And so I'm going to go ahead and just turn it over to you. And I'm going to stand back and welcome. Thanks so much.
Of course. Well, thank you so much. Here, I'm going to go ahead and try to see if I can share my screen. Can you all see this presentation? I just want to make sure.
Yes.
Janet, you can. Awesome. All right. Well, welcome everyone. Excited to see you all, or I guess I'm not seeing you all, but excited to be here with you this afternoon to talk about a topic that I think is extremely pertinent, in particular for those who are in a business setting, and that is commercial leasing. So just to give you a quick background on who I am, I'm actually a former or recovering engineer. I was a software, I studied engineering in college and then got into the software field. I did that for about 5 years as a consultant and developer for a company that implemented software systems around the world. And then I got into commercial real estate, and I've been doing this for several years here in Louisville, Kentucky. And I'm also the author of Before You Sign That Lease, the Small Business Owner's Guide to Leasing Commercial Space, that kind of walks you through the process of how do you lease a commercial space as efficiently as possible without a significant amount of heartache. I know Janet asked you guys where you guys are located. I'd love to see it in the chat box. And if you could tell me whether you're a startup or business veteran, I think that would help, because it gives me a perspective on how to tailor the presentation to best fit the audience. So if you don't mind kind of chatting away in the chat box, I think it would be really helpful. Give it about 30 seconds. I see a few people from Louisville. Awesome. London, Kentucky. Louisville, nice startup. Awesome. Congratulations on that. Louisville. So a lot of people, Louisville, Lexington, considering larger space next year. Awesome. Okay, well, awesome. It looks like we're kind of Louisville centric, but we also have people from across the state. So welcome, welcome today. So at least it gives me an idea of how to best tailor this presentation. So to start off, the first question I typically ask people that I start working with is, do you actually need a space? I feel like I meet with a lot of startups that having a commercial space is somewhat of a validation of the fact that they've made it and they're able to, have a storefront or whatever they desire. However, a lot of times your business may not be ready for a commercial space, the commitment of a commercial space, and sometimes it may not even be necessary for your business model. And so just first thing you got to kind of understand as you're going into this process is it's a long-term commitment. Now, there are situations where you may be able to get leases in that 1 to 2 year range, but typically they're 3 to 5 years. And there's other things, as we'll learn throughout this presentation, that you have to consider as part of the commitment. So this increases your business's overhead. So unless you have the revenue to justify expending on a commercial space, or at least have the projection of sales that justify the expending on this commercial space, it may not be you may not be ready to take on the commitment. However, there may also be situations where your business model just, you don't necessarily need one. I mean, there's plenty of people who do a lot of drop shipping, or if you're a software developer, maybe you're a traveling trainer where you travel to your clients. Catering business, maybe you just need to rent a commercial kitchen every once in a while, maybe have a food truck. So in those situations, it may not be something that you need to explore at the moment, at this moment in time. So one thing I like to do when I first do these presentations is to kind of tell people it's okay to not necessarily have a commercial space right off the bat. And it may not just make sense for you at this period of time. However, really what you need to do is just take some time to think about the decision. And if in fact you decide that, yes, this is the right decision for me and my business, and it's going to lead to better things for my business, then we can now discuss the different types of commercial leases that are out there in the marketplace. So we're going to go ahead and dive into the high level overview of the different lease types. Oops. All right. So the first type of lease is, or lease type, I should say, is called a full service gross lease. Typically you see this primarily in office, but sometimes you see it in retail, industrial, and multifamily. Essentially what this is you pay a flat base rent. So imagine someone says you're going to pay $3,000 a month. That means you pay $3,000 a month. And typically what this means is that the owner pays all operating expenses. In an office setting, that would mean that the landlord's responsible for electricity, water. Sometimes they're responsible for janitorial. So they'll have people that come into the office and clean up the trash and whatever else. And they're also responsible for the common areas. So if you're in an office building, they're going to be the ones cleaning the hallways. They're going to be the ones cleaning the shared bathrooms, elevators, etc. And typically, full service gross leases have the highest base rents because the landlord is responsible for paying the vast majority of those or all those expenses. So that's what typically happens when you're dealing with a full service gross lease. Number two type of lease is a modified gross lease, and sometimes it's the acronym is MG. Essentially, this is also located or seen primarily in office, sometimes in industrial, retail. But essentially what it means is that the costs are shared between the owner and the person who's renting the space. Now, these responsibilities are typically negotiated prior to lease signing. So usually the most common types of modified gross leases involve the landlord covering most of the operating expenses, except maybe electric, sometimes water, that sort of thing. And so, but again, modified gross lease, the reason why it's modified gross is because it's a modification of the gross lease where the landlord pays everything, right? So that's why it's typically negotiated prior to the lease signing what the landlord responsibilities are versus the tenant's responsibilities. And when you compare modified gross to gross leases, the base rents are typically are lower than modified gross leases because the landlord isn't responsible for all the operating expenses of the property. All right. So next up is what's known as a percentage lease. Now, this is the most common in retail centers, and this type of lease is not necessarily super common, but it's very common when it comes to multi-tenant shopping centers. So if you're trying to locate in like a strip center that has different types of businesses within that center, sometimes landlords like to utilize some form of percentage lease. What this means is that the tenant's going to pay a base rent plus a % of the gross sales that they achieve at that location. Essentially, base rents tend to be a little bit lower as a result because the landlords get to share in the upside of the percentage lease. So to give you guys a calculation, just so you understand how this works in the real world, is yearly rent is going to be equal to base rent, so what you pay per month times 12, plus a percentage rent, which is only achieved if you break a certain break point. And that's usually negotiated prior to the lease being signed. Typically, the way you calculate a break point is you take your base rent divided by the %, say a % that you agree to within the lease, and then the percentage rent is essentially only achieved if you break that break point. So let's go through an example so you guys see what I mean. All right, so let's say that you are a restaurateur and you're looking to open a restaurant in a shopping center. It's 6,000 square feet, and you get it at $20 a square foot, which means that your yearly rent for the year is going to be $120,000. When you negotiate with the landlord says, okay, I want to essentially give you a percentage rent of 5%, meaning that everything above this break point, you're going to pay 5% of your gross sales as additional rent. So the way you calculate your break point is to take your $120,000 in base rent divided by the % you've agreed to with the landlord, which would be 5%. So your break point would be $2.4 million. What that means is that any sales above that amount, so anything above $2.4 million, you're going to have to pay 5% to the landlord in additional rent. So let's say that your first year you go gangbusters and you have a phenomenal year and you have gross revenues of $3 million. To calculate your percentage rent, you would take that $3 million, subtract it by 2.4 million, and then multiply that by 5%, which gives you $30,000 over the course of a year in percentage rent. And typically percentage rent is collected either quarterly or sometimes it's collected at the end of the year. It just depends on the landlord's discretion. Make sense? All right. Next up is land leasing. Now, land leasing is not super common, in particular when you're talking about here in Louisville. Land leasing is much more common on the coasts where land costs are extremely expensive. Typically, you're going to see this in retail, prime real estate development. A lot of this happens with land lease. Essentially, what this is you're renting the land, and if you wanted to build a structure on top of that land, it becomes a fixture to that land. So after the lease is up, the building will actually become the landlord's building. Now, because of this, the land leases are usually extremely long. You're talking, 50 to 100 plus years sometimes with the options within that agreement. And you'll usually see this with, let's say a developer leases a piece of land, they develop a large building on it, and then they just rent the land for that period of time. And once that period is expired, then they'll go ahead and return it back to the landlord, but they've already made their money over the course of that 50 to 100 year period. And usually land leases are by far the most cheap when it comes to price per square foot, and the base rents are typically lower than all the other types of leases. All right. So now this is probably one of the more common types of leases, in particular, if you're in a retail setting. Net leases are probably what you're going to be dealing with. Net leases are most common in retail, industrial, and sometimes you'll see it in office, but that's not very common to see. Essentially, what the net leases means is that the tenant is responsible for paying some or all of the building-related expenses. There's 3 types of net leases. There's single net, double net, and probably something you guys have already heard of is triple net. And so we'll go through each one so you guys get a brief overview of what they mean. All right, so first up is single net. Single net means that the tenant is responsible for paying a portion or all the property taxes for the building, hence the single N in the lease description. They're also responsible typically for paying all the water, electric, phone costs, anything that's going to be utilized by the tenant within the property is typically the responsibility of the tenant. Now, the landlord in these cases would be responsible for insurance and building maintenance. So if something were to break down on the exterior or interior of the property, typically the landlord would be responsible for repairing those. All right, so double net is where not only does the tenant have to pay for the property taxes, now they have to pay property insurance as well, hence the double N. So property taxes N, the other N is property insurance. And also they're going to be responsible for their own operating expenses, which includes water, electric, phone, internet, etc. And then typically the landlord is responsible for general maintenance of the property, and that's really what they're going to be responsible for. Now, the most common types of leases in a retail setting are triple net leases. Triple net leases mean that the tenant is responsible for paying all taxes, insurance, and maintenance on their property. So typically what this means is that, you're going to get billed on a quarterly basis, and depending on what the taxes, insurance, and maintenance of the property are, the landlord is going to sum all those up and say, okay, you're going to pay a price per something per square foot based on your footprint within the center or within the building, et cetera. And similar to what we did before, tenants are going to be responsible for their own operating expenses, and the landlord is still going to be responsible for the structure and the roof. So if there's some deterioration to the structure, or maybe there's a leaky roof, that's going to be the responsibility of the landlord to take care of that. Now, there are situations where there is an absolute net lease, meaning that the tenant is responsible for literally everything, and the landlord doesn't do anything, but that's typically more so for larger corporate tenants like Walgreens, et cetera. So you're not going to see that too often within the marketplace. All right. So one thing that I really like doing with business owners, in particular those who are just getting it started, is giving them to understand what their monthly cash outflow is going to be related to their building expenses. because a lot of times business owners don't factor in net charges or CAM charges. CAM charges are known as common area maintenance charges. So if imagine where you're a part of a multi-tenant center, in order to maintain the parking lot, to clean up the shared hallways, trash pickup, et cetera, those are known as common area maintenance charges. And typically the landlord will pay for everything there and then bill it back to the tenants on a quarterly, sometimes yearly basis. And these expenses are typically stated on a price per square foot basis. So the cash outflow that you're going to have each and every month is going to be your base rent plus your net/CAM charges. And typically, if you ask the listing agent, they'll tell you what the net and CAM charge or net or CAM charges are. And then you multiply that by your total footprint or total square footage within that space. So just as an example, let's say that you are a retail tenant, you own a store, and you find a perfect 3,000 square foot space that you're going to house your storefront in. You get quoted a price per square foot of the space at $17, and then the net charges for the space are $3 per square foot. In order to calculate your cash outflow, you would take your $17 per square foot, add on your net charges, which is $3 a square foot, and then multiply that by your footprint, which is 3,000. That will give you a cash outflow of $60,000 per year or $5,000 a month. Now, the reason why this is so important is because if you do not account for that $3 per square foot, you're essentially not accounting for three times 3,000 square feet, which is $9,000 a year or $700 in change a month that you're not factoring into your cash outflow for the month related to your building expenses. I mean, that could be very difficult for you if you don't factor that in from a cash flow perspective. And again, business is all about cash flow. I mean, what's coming in, what's coming out. If you don't account for a certain expenditure, that could really put you in a bad position. And again, this is a long-term commitment. So if it's a 3 to 5 year commitment, what does that look like over that period? It could be tens of thousands of dollars. All right. So one thing I want to do is, just because through my personal experience, I've seen some people kind of slip up when it comes to different lease provisions. Now, I'm not a lawyer, so I want to be very clear on that. This is not legal advice, and I don't want you to interpret it as legal advice. So if you have any questions regarding what I'm saying, please talk to a real estate professional, or I'm sorry, a lawyer that works on commercial leases. But just to give you guys some quick tips and strategies on things you need to consider as you're looking through or going through the leasing process. First and foremost, I usually advocate my clients to try to get renewal options. Essentially what that means is it gives you the right to renew your lease at a future date. So let's say you sign a 3-year lease with the option to renew in 3 years. That means once that lease is up, you can choose to either renew for another 3 years at a predetermined rate, or you could say, you know what, I don't want to be here anymore, and you can walk away. Now, the reason why I advocate for renewal options is because you, the tenant, are in control. Because if, let's say that you start the business and it does phenomenally well, and after your 3 years is up, you don't have a renewal option, maybe the market's doing really, really well as well, and the landlord says, okay, well, I used to pay X in rent. I'm going to actually double your rent because now that's the market rate. That could put you in a bad position. Or they could just choose to not rent you anymore at all, in which case you're kind of out of luck. Now, in a situation where you have a renewal option in place, you agree to what the rent's going to be prior to even signing the lease. So let's say you pay X for the lease in the first 3 years. You could put, that in this second or renewal option, I'm going to pay X times 1.1, meaning 10% increase in rent, so that if 3 years from now the market rate's 50% higher or 60% higher, you can lock in your lower rate. Or if the market for some reason is not doing great, you can start looking at other opportunities and, pay less in rent, because now it's like, okay, well, unless you match the rent I can achieve down the street, I'm just going to move down the street. Right. So it just puts you in the driver's seat as the tenant, as opposed to the landlord. Another thing that I think is critically important is you got to really understand who's responsible for what. Now, we never go into a situation thinking of the worst case scenario, but it's really important to think that way, because I've seen scenarios where people have signed leases, or I've read leases prior to them signing it that said that maintenance of major mechanicals like HVAC, elevator, water heater was the responsibility of the tenant. So there was one situation where I was helping a lady open up an international grocery store, and the landlord said that they were going to cover all expenses pertaining to repair and replacement of these major mechanicals up to $500, meaning that, you know, the general maintenance of that would be covered. However, what happens if the furnace and AC goes out the next year? They'll cover up to $500, and then everything above that is the responsibility of the tenant. And in some of these commercial buildings, you could be talking about, you know, $7,000, $8,000, $9,000, $10,000 in replacement of some of these major mechanicals. That could really hurt a small business. And so, again, get very clear on who's responsible for what. And then if you don't agree with what is being said within that lease agreement, fight for something different, advocate for something different. Because again, it could really hurt your business if you're not taking into consideration what could go wrong. Another thing I like people to consider is a sublease clause. Essentially what this does is allows you to identify a third party. So let's say that you're 2 years into your lease and you decide, hey, you know, I don't really want to be in this lease anymore. It's part of a 5-year lease. You can't just decide to walk away from the lease. You've signed your name on the dotted line, therefore you're committed to that space. However, you can identify another business owner. Maybe they really like the space. You can bring them to the landlord and say, hey, I'd like to sublease this space to this business owner. And what this does is that you now become the middleman. So the person you identify, if the landlord accepts, would pay you, and then you would make payments to the landlord. So it essentially helps alleviate some financial burden on you as a business owner. If for some reason within the first couple of years you just decide, hey, this is not going to be a good fit for me, or maybe your business is expanding too much and you say, well, we need to move out. I mean, again, it's just trying to think of these worst case scenarios. And again, the sublease calls, typically they're going to require you to, the landlord's going to require you to show them who the tenant is, and they're going to want to verify that they have the financial ability to be able to make the payments and whatever else. But, you know, at least it gives you that opportunity to be able to sit with them and potentially just to help alleviate some of the financial burden if that's the case. Another thing that's extremely important, in particular in multi-tenant centers, is exclusivity. So let's say that you're opening a liquor store, right? And you're in a multi-tenant center. You don't want another liquor store moving in right next door. That's going to really hurt your sales, right? Because you sell the same good, and, you know, it's somewhat of a commodity. So it's not like you can make, you know, something different than this other person. So having exclusivity is maybe the only business on site that can sell liquor to be consumed off site. That could be something that could be part of an exclusivity within the lease agreement. Another thing you can consider, which I think is extremely important, is a base year stop. What this means is that, you know, when you're dealing with triple net properties, you're going to be responsible for covering all the operating expenses of the property. And typically this is going to be a price per square foot. And the landlord's going to say, okay, just as an example, they're going to say, hey, you know, you're going to pay $3 a square foot this year to cover all the operating expenses for the property. So that's the first year. However, base year stop means that I will pay in the first year, I'll pay $3 per square foot for the operating expenses. But going forward, anything above $3 per square foot will be the responsibility of the landlord. So let's say next year, the operating expenses of the building is $3.10. You as the tenant would pay $3 a square foot, and the tenant or the landlord would pay the difference, the 10 cents a square foot in operating expenses. Now, not all landlords are receptive to this, but sometimes, depending on the negotiation that is involved within the transaction, you're able to negotiate a base year stop, which can save you a good amount of money, especially if your footprint's significantly larger than, you know, other types of businesses in expense every single year. And then finally, the most important thing is to carefully review your lease. If you need to read it 3 times, if you need to read it 5 times, if you need it 20 times, it doesn't matter. You're signing a document that's going to make you committed to something for multiple years, sometimes as much as 5-10 years. So you need to read the document. You need to understand everything that's involved within that document. And some lease agreements are not short. I've seen lease agreements in excess of 20 pages. So you need to get very clear on what exactly you're committing to. And if you don't understand something, talk to a lawyer. A commercial lawyer that works a lot with leasing is critical. And I definitely do not want to underestimate this, because again, this is a long-term commitment. This is something that's going to impact your business long-term, and you want to make sure that you know exactly what you're getting into. All right. So I know we went over a lot of information, so it's probably a good thing that this is recorded so you guys can go back and hopefully you can learn a little bit more about the different lease types and maybe refresh yourself. But what are the next steps if this is something that you're interested in doing? Well, first off, determine whether or not you need a commercial space. I think that's the first and foremost thing. And sometimes you just need to set aside and really get a feel for whether or not it's really going to help your business grow and expand and succeed. Number two is to surround yourself with the right team. Talk to a commercial real estate lawyer, talk to a commercial real estate agent, talk to, banks, get a feel for, the Small Business Development Center. It's a phenomenal resource. I was talking to Janet before this presentation, and, I interviewed David Etkin on a meetup that I do. And I couldn't believe when I started doing the backstory research on David and the Small Business Development Center, I couldn't believe the amount of resources that were available for small business owners. And I was like, how do people not know about this stuff? It was just amazing to me. But that's a phenomenal resource or a great team to have in your corner. Along with that, you start searching local and national sites. Locally in really Kentucky and Southern Indiana, we utilize KCREA. It's essentially the commercial MLS for Kentucky, the Kentuckiana region. And then there's national sites like CREXI and LoopNet that you can search for, and these are 100% free to search on. So feel free to just go on there and see what's available and start getting familiar with what the market rates are for different types of properties. And then finally, I cannot stress this enough, read each lease agreement carefully and really understand what you're getting into. And if you don't understand something, please lean on your attorney. And even if you have to pay them a couple $100, it's way better to pay on the front end than have to pay thousands, if not tens of thousands on the back end, because something that you didn't really understand before getting into it. So, all right. So that's pretty much what I had for you. I know I kind of went over a lot of things, so wanted to open up for questions. When you were looking, so Rodney asks, when you were looking at lease space, what is the going rate on a square foot? So yeah, that's a great question, and it unfortunately it really depends. Again, it depends on what property type it is. If it's retail, industrial versus office versus mixed use. It all depends, and it's also market specific. So what the going rate of for industrial space in Danville is probably going to be different than what it is in Jefferson County versus it's going to be different in Oldham County. So it really just depends on the type of property and where it's located. So I wish I could be a little bit more specific with you, but I hope that answers your question. All right. So Devani King asks, any tips for negotiating renovations, build outs for business owners? For example, the hood space can be very costly for new restaurant owners. That's 100% true. What we've been seeing a lot of recently is a lot of landlord or a lot of tenants electing to not even deal with the build out and trying to identify second generation or second gen spaces. So finding existing spaces that have the hood, that already have the grease trap, that have all the components of a restaurant already in place, so that they can just move in, maybe modify a few things and start operations. As far as negotiating for build outs, it's tough because right now a lot of commercial contractors and construction companies, they're hindered on the back end too. Their supply chain has been affected by COVID, obviously, and a lot of material costs have been extremely high as well. So there's only so much you can negotiate on. But I would say, if anything, if you haven't already gone through the process of identifying or selecting a site that needs a significant build out, maybe consider looking at second generation spaces, ones that maybe a restaurant had moved out of, or, that already have some of the components in place prior to actually pulling the trigger. All right. So Oliver, he had a question. He said, I joined late. No worries at all. Any guidance on what the tenant versus landlord should be responsible for in terms of construction of a building that's being renovated but was not utilized before the renovation? In other words, if the landlord is renovating / constructing a white box commercial space, then how much beyond white boxing should the landlord cover in terms of costs? That is also a phenomenal question. Again, it's all negotiable. The landlord could just say, look, they could be advertising the space and say, look, we're going to get you in a white box. Everything after that is your prerogative. They could also say, we're willing to give you what's known as tenant improvement allowance. So they'll give you up to, let's say it's typically a price per square foot. So let's say you have a 2,000 square foot space and they say, we'll give you $50 a square foot in tenant improvement allowance. That's essentially means 50 times 2,000 will give you $100,000 in improvement allowance. So what the landlord's willing to cover. Typically, when you're negotiating tenant improvement allowance, they're going to want to recoup that in some capacity. So that means either the rent's going to go up. Typically, the term is going to be longer. So instead of maybe a 3-year lease, now you're looking at a 5, 7, 10-year lease. Because again, they're going to want to recoup the money that they invested within the space, even if it was quote unquote vacant. So it is very much a give and take. And I think if I were to give you any advice, I would say, you know, what's most important to you? Is it having flexibility in the lease term, or is it, I don't want to spend as much on the front end and I'm willing to commit to a space on longer? And in which case you could say, hey, look, in exchange for $30,000 or $40,000 in construction cost in the space, I'm willing to sign on to an extra 2 years of a lease, or maybe raise my rent by $2 a square foot, you know? So it's all give and take, but it's all negotiable. Okay, so Isaac, he asked, I have a government-run facility looking to lease a connected clinic that comes fully equipped. My responsibility would be staffing, supplies, software. They have not given me how much they are leasing it for, but will be meeting with them this week to discuss. Any suggestions outside of what you have spoken about today? Thank you. Okay, that's a good question. Yeah, I mean, if you're looking for a space that's already fully equipped, I mean, you're going to have a limited selection. So really getting a feel for what the market looks like, I think is going to be important to you. So go on KCREA, go on CREXI, start executing some searches for, you know, already vacant existing clinics and get a feel for what's out there. So you can educate the person you're going to be working with about what the market's saying, because it's one thing to say, hey, I want a space for $2,000 and I want this all equipped. But if the market is saying, hey, if you want all this, it's going to be $5,000 or $10,000 a month, then you already know your answer. So that's why it's so important to really get an understanding of the market itself, so you're better educated about what the expectations are, both on the tenant side and the landlord side. So hope that answers your question. All right, so Rodney asks, what is something in the contract that should be a caveat to watch for that can affect cash flow that may not appear on the surface to be minimal, but it could in the long run, it could hurt you? Again, that's a great question. And I just want to reiterate that I'm not a lawyer. So any advice that I share is not advice. It's just, you know, my own personal experience. So if you have any questions regarding that, please consult a real estate attorney. As far as cash flow is concerned, again, just calculating those shared costs, you know, those net charges, the CAM charges, those are the ones that I think business owners are most shocked by, because they're just like, oh, wait, like I've already budgeted, you know, let's say $3,000 a month to cover my rent. But, oh, now there's an additional $600 or $700 or $800 a month that I didn't factor in because of these net expenses. And that could really throw them off depending on your business model. If you're a low margin business, I mean, that could really affect your margins. And so again, I think that's probably the biggest one. And then again, thinking about the worst case scenario, what happens if the AC goes out? What happens if the furnace goes out? What happens if the roof caves in? Who's responsible? What's that look like from a financial perspective? Those are all questions that I would highly encourage you to ask, because it's probably it may not come up, but if it does, those are business killers. Oh, Oliver, when is the commercial broker generally paid post negotiating the lease? By the way, the landlord and tenant, if it is after the lease has been signed, but before the space is occupied, if the tenant's business fails, is unable to fulfill the lease terms, when is the clawback generally for the commercial broker's fee that was paid is returned? It seems odd to pay a commercial broker a fee for the term of the lease if the lease ends early. Yeah, I mean, that's a great question. What typically happens, each broker is different, but typically what happens is it's usually half upon the signing of the lease and then half upon the first month's rent. So when you receive the first month's rent, whether that's, let's say you have a free rent period of, 3 months, right? You let the tenant have 3 months in order to get them going. Once that rent payment comes in, that's when the next installment would be due to the brokers. And you're right. I mean, you kind of take a risk as far as as far as putting a tenant in place. And that's why it's usually it's often an uphill battle for a lot of startups, because a lot of landlords are like, we don't know if this is going to work out. And so, I think if you're a landlord, on the landlord side, you really just have to screen your tenants. I mean, it's the same on the in any type of setting, whether you're on the residential side or commercial side. You just want to screen your tenants and make sure that in fact they do have the number one, the resources, or number two, have them sign a personal guarantee. There's other ways you can do it, but I mean, I think it comes down to just screening is the biggest thing. And so, that's why having typically what you would do is have a broker on your side, on the landlord side too, so you can get a better understanding of who the other person is and what their viability is as a tenant. And then, from there you can, hopefully consummate the agreement, and it becomes a successful venture for both parties. But again, anything in entrepreneurship is a risk, both on the landlord side and on the business owner side. So, Oliver asks, is a market to have a personal tenant sign a personal guarantee? Yes, that's actually quite common. Sign a personal guarantee. In particular, if you're just starting out, that's actually very common to do. If there's no other questions, I just really want to thank you all so much for stopping by. I really do appreciate you coming by and learning about this subject that I find really interesting. I actually really enjoy learning about this and teaching people about this. So thank you so much for the opportunity to be here. As a gift for actually being here, I wrote a book called Before You Sign That Lease, The Small Business Owner's Guide to Leasing Commercial Space. And it's a step-by-step guide that explains you how to lease commercial space from start to finish. That if you look at that link, it'll give, you can download the free ebook. Essentially, you can just review it and hopefully use it as a guide to help you get wherever you want to as far as the commercial leasing process is concerned. I'd be happy to make that available to you guys. So, oh, yep, she's shared it in the chat box as well. So feel free to take that and get yourself a copy of the ebook. Okay. All right. Janet, did you want me to say anything prior to closing out, or do you need me to? Oh yeah. She said that hopefully I'll be able to come back in 2022 and talk about different subjects pertaining to commercial real estate. Maybe we'll expand a little bit more on the commercial leasing side, or get into the purchase side, or whatever. I'm happy to be here to be a resource to this phenomenal organization, because it really is amazing. I mean, I was shocked that more people didn't know about the Small Business Development Center when I started doing research on it. And, ever since then, I've been a strong advocate for people, especially those who are getting started, to be able to reach out to them and utilize the resources they have at their disposal. So cool. All right. Well, again, thank you all so much. It's been great seeing you all, and wish you all a very happy holiday season with your family. And we'll see you all I know some of you guys will be able to see Janet a little bit sooner than me, but hopefully I'll see you all in 2022.